Last week was an interesting time for the UK, to say the least. Riots gripped towns and cities across the country. Then the British Chancellor of the Exchequer, George Osborne, said the UK recovery will take longer and be harder. This came after the Governor of the Bank of England said the bank may resume some form of stimulus. And I'm joined by one of the most accurate FX forecasters in the industry, Stephen Gallo, who works for the London-based Schneider Foreign Exchange. Stephen, thanks for joining me. Do you think the problems in the US and eurozone has meant the UK has rather unfairly escaped the attention of the markets?
The buoyancy of sterling, even versus a fundamentally flawed currency like the dollar has, it surprises me because I actually think sterling dollar, even despite the problems in the United States, should be about 5 to 6 cents lower, closer to the 155 level than the 160 level or 163 level, which is where we currently are. I think the sterling has escaped a lot of attention because of what's been going on both sides of the Atlantic, but not necessarily in the UK. But I think the UK has a lot of structural problems. It has a lot of problems related to growth potential, which are largely getting ignored because the UK was one of the first countries to put together, a package for dealing with the deficit. You remember that happened in the emergency budget last year, shortly after the election. So we haven't really revisited, the outlook in a serious way. We haven't really revisited the outlook for the UK's AAA rating. We haven't really revisited the outlook for the UK economy as a whole. And in fact, what I think has been happening is, as you rightly say, sterling and the UK have escaped a lot of attention because of what's been going on in the US and Washington and what's been going on in the euro area. That has actually added a degree of support to sterling because even though, gilts are not necessarily a good buy from the perspective of yield advantage, I mean, the UK has some of the lowest real interest rates in the world. What's happened is that support has come into the pound because there really haven't been that many avenues, liquid alternatives to euro-denominated assets or US dollar-denominated assets like gilts. And so, they've held up in light of the recent turmoil on both sides of the Atlantic Ocean. And also as well, the recent deterioration in risk appetite, it definitely causes more money to stay onshore than move offshore in the UK. You have obviously a lot of financial institutions, a lot of hedge funds based in the UK, which raise a lot of money in sterling and then invest abroad in higher yielding assets. Well, if demand for those higher yielding assets wanes, as it has been doing in recent weeks, then a lot of that money stays onshore, and that doesn't add to pound weakness. So the pound has stayed relatively afloat. But some of that buoyancy is astounding given the extent of the problems that we have in the UK.
And how do growth prospects in the UK compare with other core European countries?
I think based on the consumption nature of the UK economy, based on the sort of based on the degree to which the services sector, particularly financial services, outweigh a lot of other things in the UK, I think that definitely the UK economy is going to have a more difficult time when it comes to growth potential. And I think you've already been seeing this. I mean, if you look at the performance of the German economy, a lot of the core European countries, even some of them that aren't in the euro area but are attached to that strength of the core euro area countries like Sweden, for instance, a lot of these countries have been doing exceptionally well. And it's not only because they're geared towards manufacturing and exports more so than the UK is. It's also, for example, when you take in consideration Germany, I mean, this is a country that has developed massive structural reforms in the last decade or so, and it's now reaping the benefits. And I look at the growth picture and the inflation picture in a country like Germany compared to the UK. I mean, the UK is barely growing, and it has some of the highest inflation in all of Europe, whereas the German economy, for the most part of the last 6 to 9 months or so, has been going gangbusters, and it's running at a rate of inflation that's roughly half of the UK's. And I think part of that high inflation in the UK is due to the fact that the UK virtually has very little growth potential. It's running on a model of growth which propelled it through the last decade or so during the heady days of the credit bubble and during the financial services boom of the mid to late 1990s. That now has died out now, and without that model of growth working properly, the UK needs to undergo some heavy structural changes in order to improve its longer term sustainability and outlook, and I don't think that that's happened yet. And so I foresee potentially more pain for the UK economy, more pain for sterling, if some of these issues aren't dealt with properly.
And what do you make of Mervyn King's comments? Are you expecting more stimulus from the Bank of England? Will it work? And will it lead to more inflation?
Okay, so first of all, do I expect more? Well, certainly, as you pointed out in your comments, I mean, Mervyn King has prepared the markets for more. I think if you look at some of the moves we've seen in gilt yields over the last week or so, I think the bond market anyway, is expecting some kind of additional stimulus from the Bank of England. Will it work? Well, it will probably buy us some time. I mean, that's generally what stimulus at these levels generally tends to do. I mean, when you have a broken model of economy to a large extent, or a model of economy that's suffering, additional monetary stimulus doesn't really do much but buy time and kick the can down the road, and prolong the inevitable, which is a significant adjustment. So I don't think it'll necessarily improve growth prospects, but I do think it will buy time. So it's possible that we could see some form of stimulus within the next 3 to 6 months, maybe even sooner. What kind of form that stimulus will take? Well, your guess is as good as mine. I think the level of inflation is something that is going to box the Bank of England into a corner. So perhaps QE is not, or QE in the traditional sense is not an avenue that they can go down. But we may see some other creative forms of easing from the central bank if the option of, for example, purchasing gilts isn't open to them. But it remains to be seen whether or not they're going to let those high inflation figures box them in. Because remember, the official stance of the bank is that inflation is going to actually fall below the target in 2012, a stance that is becoming, to me, less and less tenable, but that is nonetheless the official stance of the bank.
And finally, Stephen, do you think sterling is currently fair value?
So for dollar sterling, I mean, we think fair value for sterling dollar is actually much lower than 160 than the current pair indicates. I mean, the pair is hovering in a 160 to 164 range for much of the last few months or so, and we think actually fair value is in a sort of 153 to 157 range. Perhaps if there are bouts of instability in the currency, we could even go below the 150 level. But we think fair value is probably between 153 and 157. Whether or not those values materialize, though, again, is a different question. But that is where we think fair value is. Versus the euro, despite the ongoing problems related to the institutional framework in the euro area, I actually think that the core of Europe, what's going on in the core, the growth, the differentials in growth potential, the differential in interest rates, is going to add more support to the euro than to sterling. So we see euro sterling actually at fair value closer to a 90 to 93 range rather than an 85 to 87 range, which is what we're currently in. So we actually see some more downside there potentially for sterling versus the euro before the end of the year.
Thank you, Stephen. Dukascopy TV again bringing you market insight from the industry's leading experts. Stay tuned for much more. Goodbye for now.